Hello there.
Hello everyone from a very wet and rainy countryside. This is Battle 4 and I'm the gentleman investor. Let's invest. As always, we're going to reveal who won last week's battle. We're going to have a portfolio update and we're going to find out who's battling it out in this week's challenge. Without any further delay, let's get underway. Money Supermarket and Rightmove fought it out last week. We've tallied both the votes, and this week's winner is Money Supermarket. Here's a quick reminder about how our investments are arranged. Every week we invest £25 into 3 portfolios. That amount goes up as we get more subscribers. The first portfolio is the Battle Royale, where we invest in the winner of 2 stocks that get pitted against each other each week. The second portfolio is the benchmark, which is how we measure the performance of the Battle Royale. Each week the £25 goes into the same fund, the Vanguard FTSE All World. It measures the market and so we can get an accurate representation of how the Battle Royale is performing. The final portfolio is the income generator. The sole purpose of this portfolio is to make money, and we're going to pay it out to a lucky subscriber every 6 months. And that's it. So, how are they doing? We have 2 subscribers. Yay! That means £25 into each portfolio. Well, the benchmark, which holds the FTSE All World and is our golden standard, it is currently, over the last week, up 1%, and we're very happy with that. So how's the Battle Royale faring? Well, it's now made up of 3 stocks. We've got Tesla, Money, and Tesco. Tesla and Money were up over the last 7 days, although since we've just invested in Money, that doesn't help us very much. Tesco's down 1.9%, quite a big drop over the last 7 days, but we're long-term investors, so we're not too worried about that. How's it faring overall? Well, this is how its performance looks. We're up 4.3%, thank you Tesla, and we're beating the US market. And how's the income generator faring? Well, not too badly, considering the UK market was down 3.2% over the last 7 days. It's holding pretty steady at a 0.2% increase. Although I'm not looking for much capital growth from this, I'm waiting to see how much income it makes us. And speaking of, we're now at a total value of £75. Annual dividends are up to £2.36. The next payment's 46p, and the next winnings that you guys are going to get paid out is 87 pence. So all going very nicely over there. So how are they all performing overall? Let's have a look. Very happy with the Battle Royale. It's beating the market. It's increased by 3.15% overall, while the FTSE All World is up 1.07%. Very happy with both of those, and the income generator chugging along at a very handy 0.15. All going very smoothly.
3, 2, 1, fight.
Following the Fed's big rate cut, this week's theme is REITs, as they tend to go up as rates come down. So the first question is, what is a REIT? Well, a REIT is a real estate investment trust. These are companies that own, finance, or manage properties, but are then legally required to pay most of that income out to investors. Because they typically carry debt on their balance sheets, falling bank rates is good news for them. As I'm hoping we're going to be moving into a period of rate cutting over the next couple of years, I think this might be a good time to start looking at investing in REITs. So the question becomes, which REIT to pick and how to select a good one? Well, we need to look at growth in earnings, which stems from higher revenues, and those revenues often come from higher occupancy rates and/or increasing rents. We could also consider the management teams and their plans for the future. Once we've looked at a few that may be good options for future returns, we need to try and see if they are over or underpriced. We do this by looking at the net asset value per share, or estimates of what their property portfolios are worth after subtracting debt. For this week's investment, I'm suggesting we look at Impact Healthcare REIT, ticker IHR, and Triple Point Social Housing REIT, ticker SOHO. Let's look at their high-level metrics quickly. The two are similar in many ways to each other, however there are a few things worth noting. Impact has a slightly higher market cap, at 378 million to Triple Point's 258. Its revenue is 50 million, whereas Triple Point is making a revenue of 39 million. The average volume for Triple Point is 748, whilst Impact's is 546. The dividend yields are also relatively close, with Triple Point coming in at 8.31% and Impact at 7.51%. Triple Point aim to provide shareholders with an attractive level of income, together with the potential for capital growth from investing in a portfolio of social homes. Triple Point specialise in supported housing, which, they say, gives residents greater independence and dignity than traditional institutional care, while still addressing their specialist care needs. Let's take a look at their snowflakes on Simply Wall Street. Again, both are pretty similar here. However, Triple Point has the slightly better future, while Impact has the slightly better health. That's, of course, if you believe what Simply Wall Street tell us. So all this considered, it was a pretty close call, but I suggest we invest in Triple Point. I think that Triple Point has the slightly better future, showing a significantly higher revenue growth rate. Given the high future growth, coupled with lowering bank rates, I think these shares could do well in the future. And in the meantime, I'm happy to be investing in a stock with an 8.31% dividend yield, which is stable, may soon grow soon, and has a payout ratio of 76%, which isn't too bad for a REIT. Please let me know what you think. Do you agree, or do you think we should be investing in a different REIT? Please let me know in the comments. Thank you for watching, everyone. See you next week.
Goodbye.